Welcome to the universe, full of galaxies, stars, planets, and asteroids. There lies one little planet. This planet is named Earth, and here lies the human race. Like all other living species on the planet Earth, humans are born and eventually they die. Throughout the span of their life, these tiny little beings acquire assets such as homes, cars, couches, basketball hoops, and many other objects. However, once a human reaches the end of their lifespan, a question must be asked. Who receives those assets? This question is answered with a simple protection plan for asset distribution following death known as life insurance. There are several types of this insurance, all dealing with the death of a human and their assets. But one of these types that us aliens have the most knowledge about is Universal Life Insurance. Prepare for your space briefing on the all-encompassing Universal Life Insurance.
Universal life insurance is a form of cash value life insurance. That means when a premium is paid, a portion of the premium pays the actual cost of insurance, and the remainder of the premium is applied to a cash account known as the cash value. This life insurance policy is a combination of both term life insurance and whole life insurance. It has the favorable aspects of the low-cost protection of term life insurance and savings element like whole life insurance. Universal life insurance allows the policyholder to use the interest from their accumulated savings to help pay premiums over time. Premiums within a universal life insurance policy are broken down by the insurance company into two major components, which are cost of insurance and cash value, or savings component. The cost of insurance must be covered so the policy remains in force, but premiums may be shifted over time based on the policyholder's needs. Premiums paid over the minimum cost of insurance accumulate within the cash value portion of the policy, and funds can be used to pay premiums. There are two main types of the death benefits for this permanent life insurance policy. The first one is Type A. With this type, the death benefit amount stays constant for the entire policy. However, with the Type B death benefit, the policy proceeds increase over time. These proceeds should equal the sum of the cash value and death benefit. This can be beneficial because the cash value will grow faster over time. Who is universal life insurance for? It is perfect for someone who is expecting and open to changes in their life, like the birth of a child, because there is flexibility with premium payments.
It is important to distinguish the difference between the universal life insurance and other types of insurance. Whole life insurance and universal life insurance both fall under permanent life insurance options, meaning it provides lifelong insurance along with the ability to build upon the cash value of the insurance policy. However, the difference between these two comes from the methods of accumulating this cash value. With the universal life insurance policy, the insurance company establishes a minimum interest rate within the individual policies. If the portfolio outperforms this minimum interest rate, then the excess earnings are added to the cash value of the universal life insurance policy. The ability to earn more than the minimum interest rate is the differentiating factor between universal life insurance and whole life insurance. Also, if you skip a premium with universal life insurance, the cost of the insurance is deducted from the cash value of the universal life insurance. However, with whole life insurance policy, if you skip a premium, the cost of insurance is borrowed from the cash value of the insurance, establishing a loan. The main difference between term and universal life insurance is that term does not provide lifetime coverage like universal life insurance does. The same calculations are done to determine annual premiums for term as universal, except instead of for 20 or 30 years, it is calculated to insure up to age 100.
While universal life insurance does appear to be a simple solution to your life insurance needs, there are disadvantages and advantages of investing money in a universal life insurance plan. The disadvantages are found in the cost of universal life insurance, the interest rates on universal life insurance policies, and the monitoring of the universal life insurance policy cash value. The first disadvantage of universal life insurance is the high costs. The cost increases because of the extended time period that the universal life insurance policy covers. The universal life insurance policy is usually 3 to 4 times the cost of term life insurance due to premium prices, fees, and the extended time period. The next disadvantage is the low interest rates found on the universal life insurance policy. This means the universal life insurance policy does not perform well as another investment because interest rates on the policy are relatively low. The last disadvantage is the need to monitor the cash value of the life insurance policy because if there is not enough cash value available to sustain the policy, it will lapse or cancel. The advantages of the universal life insurance policy include flexibility of premiums. This is beneficial to the policyholder if at the end of the month they find that they do not have enough money to pay the price of the premium. They can rely on the cash value built from when the cost of insurance was low to cover the cost of premium for that month. In other words, the amount of the unpaid premium will be deducted from the accumulated cash value. Another advantage is that universal life insurance is a type of permanent life insurance, meaning that the plan does not expire. Tax deferment is an additional advantage as the cash value investment portion and the death benefits of the universal life policy are not taxed upon payout. Lastly, the most important advantage is the accumulation of the cash value. Over time, policyholders can access this cash value without affecting the guaranteed death benefits.
Here's an example of someone in whose situation it would be beneficial for them to invest in a universal life insurance policy. Say they're a single mom who's preparing to give birth to a child. In this situation, universal life insurance could be beneficial as this woman becomes someone who has to prepare for a massive change in her life, which universal life insurance allows for through the flexibility found in premium payments.
Well, that is all, friends. Farewell and enjoy your travels. We return to the stars and hope to see you next time when you need a little information about dying. I mean, life insurance.